2025 has been a crazy year. We started the year off with a big sell-off, headlines about tariffs, and then the market came roaring back to new all-time highs, rebounding over 50% from the April 8th lows. But here's something most people missed. Some solid, high-quality companies did not get that same rebound. Their prices just didn't catch up to their actual fundamentals. So today I'm going to show you 5 stocks that didn't pop with the rest of the market and why a group of people believe that they're set to rebound big in 2026. Now look, most investors only focus on the winners that they see in the headlines, the stocks that go up a lot. They look at the S&P up 16% and think, I'm making money. But that is not the whole story. Some companies did very well in terms of their business results. They just didn't see their stock prices reflected. That's exactly what we're going to talk about today. Companies with strong fundamentals to see if they have a big rebound potential, not random guesses. Stocks that actually haven't fully recovered in order to see if any of them are really worth our money and time at the current price they are selling for. All right, guys, so let's take a look at what CNBC is saying about some of the biggest potential rebound stocks heading into 2026. Now, just to be very, very clear, this is not my personal list. This comes from a recent article that caught my attention, and I think it's worth going through together. My goal on this channel is to teach a process. That means taking some of my ideas, analyzing them, taking some of other people's ideas and the market's ideas and saying, what do we really have here? So this article pointed out 5 high-quality companies that didn't get the same love, and they believe these names are primed for a strong comeback in 2026. So here's who they called out. First off, Amazon. They said the stock struggled because of AI competition and retail margin concerns. Second company, Eaton, Cleveland's own Eaton, with booming AI data center demand, but a flat stock. Nike, which is a company that I actually do own. Again, don't buy a company just because anybody on the internet owns it, or even if freaking Warren Buffett does. But they're early in their turnaround plan with a new CEO. Palo Alto Networks. They were slowed by recent acquisitions, but still a cybersecurity leader. And Starbucks, another company that I own, rebounding U.S. sales and restructuring in China. A lot of things to go, a lot of great stories, but also a lot of negative stories attached to each of these companies. Now, I would never say that any of these are slam dunk buys. And I don't want you jumping in just based on an article. It's the opposite of what we're teaching on this channel. In this video, I'm going to pick 3 of these and analyze them using our principle-driven investing process and approach. I'm going to break down the story behind these companies, the valuation metrics I rely on, and using our stock analyzer tool, the price that turns them into I'm buying. We're going to look at the fundamentals, the valuation, and the real opportunity, not just the hype. Because remember, investing isn't just about what you buy. It's about what you pay. And even more important, in this video, I am giving you the tools and principles that you're not going to hear anywhere else on YouTube. So the next time you analyze a stock, you're going to have an edge over 99% of investors out there just by understanding this process for looking at stocks. So stock number 1, stock I own is Nike. Let's pull it up in our stock and in our software. This is one of the strongest brands in the entire world, and it has very loyal customers, high margin products, and massive international reach. Under new CEO Elliott Hill, Nike has launched its Win Now strategy, which is focusing on innovation in core sports like running and basketball, cleaning up old inventory, and rebuilding its brand culture for a financial rebound by 2027. The plan includes smarter product launches, better distribution through both Nike Direct and wholesale, which now includes Amazon, and cutting costs to boost margins long-term. While analysts are optimistic about Nike's comeback, they are also cautious about near-term pressures like tariffs, rising costs, and tough competition, which could hurt earnings in the short run. Guess what? I don't give enough about the short run. It is hilarious to me that the analysts sit there and go, well, in the short term, they have these pressures. Okay. Who cares? That's what I want you learning. Guys, we're here to look at these companies for the long run. We're going to analyze the stock using a 10-year or more analysis on our stock analyzer tool. And I'm going to show you the price that I would pay for Nike. Okay, so Nike is a $100 billion market cap business. This is the price you pay if you bought every share on the market. It's got a $115 billion enterprise value. This difference right here is $15 billion. When the enterprise value is 15 billion above market cap, it means essentially there's about 15 billion in net debt on the company. All right. Last year, they made $3 billion in free cash flow, which is down significantly from their 5-year average of $4.9 billion. Turning things around, getting rid of inventory, writing things, well, the write-offs aren't in the cash flow, but this is part of their turnaround. What I like about this company is free cash flow and net income are very, very similar. Love that a lot. Okay. It's selling for 20 times 5-year PE, 20 times price to free cash flow. 5-year return on capital, 18.5%. What does that metric mean? Because it's very, very important. It means that when they invest money into the business, they get about 18.5% return on their capital if they were to do it over and over again, and if that were possible. Now, is it easy for a company like Nike to do that? It's very difficult for very mature companies to get these kind of returns. But the point is, this shows this is a moat business. This is a high-quality business, and this matters for our valuation. Now, revenue growth, 4% a year for the last 10 years, 4.5% a year for the last 5, negative growth in the last 3 years, negative 0.5%. But one thing I do love, 10-year profit margin of 9.8, 5-year profit margin of 10.5%. So 1 year, 6.25. They're definitely weeding through, turning things around. In our community, we have almost 100 members who have voted, and the average rating is a hold with an intrinsic value of around 59 or 60 bucks, and it's currently selling for 68. All right. So 8 pillars, 8-pillar thriller. Now remember, our 8 pillars are not here to say buy or sell. They're to tell a story. I'm going through all these numbers. I'm going to go through more. If this sounds overwhelming, guys, we've all been there. I don't want to hear it. Warren Buffett at one point was overwhelmed by this. I'm here to simplify this as much as possible. All these key metrics, it's important you do understand those. So I created a very simple cheat sheet for you, absolutely free. Click the link below and we will send you a key metrics PDF. It'll describe all of these metrics, explain them to you, why they're important, how to calculate them, etc. That way, when you listen to our videos and you look at a company, you can understand these things as you're looking at it through our software. I love it. And it's really important. This is a big reason why I teach on YouTube. I want us all speaking the same language and realizing that when we buy a stock, we are buying a piece of a business. So all check marks here. I love that they're buying back shares at these low prices, at these low valuations, because I think Nike is a premium business. The question is, how much of a premium should they get? That's the real question. Revenue growth, net income growth, cash flow growth. What I love here is cash flow growth is much higher than net income growth in the last 5 years. That's great. All right, let's go to analyst estimates. Now, analysts see a big drop in earnings this year, next year to 20 down 22%, and then right back up. Still over double where it was in the last year, going to $4.73. Not bad. Revenue, basically flat. 5%, 6.7, 5.6. The question becomes, they did 4% a year for the last 5 years. Here they're at 5 or 6%, but turn things around. I'm actually surprised about the profit growth. I would have thought it would grow a little bit faster than that. Well, actually, you know what? This is pretty fast growth for their profit, actually, come to think of it. All right. So now we have the stock analyzer tool. This is the tool that I use whenever I start at any company. My goal here is to enter values, my projections for the future. I do low, middle, and high assumptions. The reason I do these is I don't know the future. It's unknown. But I can, especially with a company like Nike, I can put some reasonable estimates here. So let's pull up and see what reasonable estimates I've done in the past. 10-year analysis. Okay. I did 3, 5, and 7% revenue growth. For profit margin, I did 9, 10.5, and 12. Now, what is the PE and price of free cash flow 10 years from now? Now, I'll always hear people saying, well, Paul, what's the current PE? That shouldn't matter. What should matter to you is, what should this company sell for? It's a premium business with high returns on capital. So I always tell people the market average is 15 to 16. You go higher for good quality companies, lower for bad ones. Higher for good balance sheets, good growth potential, high returns on capital. This is definitely a moat business, so I'm going to go higher. I did 19, 22, and 25. If you attach yourself to what the current P is, you're either going to overpay or underpay at some point. The key is to sit there and say, what is this thing worth in a normalized market? And then finally, I'm doing a 9% return. Guys, keep in mind, I'm not buying based on a 9% return. This is purely to figure out the intrinsic value of the business. Obviously, if I want to buy an individual company, I need a margin of safety. For those of you out there who are doing this, put in a higher number than 9%. I definitely do. But for the intention of this video, the goal for me is to sit there and show you, this is what I believe the company is worth. So I put my assumptions in, I hit the analyze button. The stock's currently at 68. The low price of 50, high price of 109, middle price of 75. So guys, I think it's worth more than our community members think it's worth. More power to them. And this current price return does include dividends. So don't add the dividends again on top of that. So guys, a really important thing I like to mention in videos. Most investors are going to lose money because they try to pick some massive winner. The best investors do the opposite. That's what we're trying to teach here. We're trying to eliminate the obvious losers first. And the quickest way to do that is looking at valuation. If you overpay for a great story, you'll get a bad return. Our goal here is to eliminate those losers that everybody feels are winners, but they're just priced way too high. That's what's key here. Even though they're great stories, if you pay too high a price, you're going to get burned. Stock number 2, Amazon. So guys, Amazon is a company that is incredible. I did not understand the Amazon story for a long time. They're a tech and retail giant with big plans to grow its most profitable areas like AWS, which is their cloud computing, advertising, and artificial intelligence. AWS is Amazon's money-making machine, and the company is pouring over $100 billion into AI infrastructure and data centers to stay ahead of competitors like Microsoft and Google. At the same time, Amazon actually has an ad business which is growing fast. What this means is when you go on Amazon and you type in a product, let's go type in something here in Amazon just to show you, because people will screw this up all the time. What's the last thing I looked for on Amazon? So guys, when you go into Amazon, here are my recent searches, by the way. 6-foot ladder, toilet plunger. Don't worry, this is one of my properties. I didn't break my toilet plunger at home. But let's say you type in 33-inch black monitor, like a monitor. Okay. What people don't realize is sponsored. These are the 2 first spots. People who are selling this product are advertising this. That's a huge benefit to Amazon. We have a company that sells a lot on Amazon, and we spend 15-20% of our revenue just on Amazon's advertising business. It's very, very big. So while e-commerce still provides steady cash flow, Amazon really is focused on cutting costs and boosting margins by using more robots and AI in its warehouses and logistics network. We are going to analyze this stock with our stock analyzer tool, and I will show you the price I need Amazon stock to sell at in order for me to buy it. Now, going back to the metrics on Amazon, here's something that really changed a lot for me over the years. They changed in which the level to which gross profit was reported. Back in the day, it was reported at 14 to 15%. And people would tell me, no, Paul, it's more like 45. And I'm like, well, if it's more like 45, why isn't it showing me 45? Well, they finally got around to it. Profit margin, last 10 years, 5.7%. Last 5 years, 6.5%. Last year, 11%. Amazon didn't make money for 17 years, and now they're just making a ton of money. And that's great. Low returns on capital, but getting better as their cash flow gets better. Amazing growth rate here. Look at this revenue growth. 10-year growth rate of 21, 5-year of 14, 3-year of 11%. Guys, this is the everything business. And I love that they're starting to sell cars on Amazon, because nothing aggravates me more than negotiating cars. And I buy, my stepson and I have a Turo business where he runs it basically. And I look at it and go, whenever we're looking at a car to buy, I just hate the agonizing, okay, how much? I actually just go in there because we buy used cars. And luckily they all say like, this is the price. And I just don't even negotiate. If the price makes sense, I just do it. That's the way I think cars should be bought. But more on that later. Let's go here to our 8 pillars. Oof. Ugly. This doesn't scare me. You know why? Guys, I want to show you something. Look at this free cash flow. 5-year average, 8.4 billion, 1 year of 10.5. Guys, look at this net income. Massively different. 36.8 versus 76 on the 1 year. Look how much higher it is than free cash flow. To most investors, that's a red flag. And it should have you go, why is that? But I'll show you why. Let's go to their cash flow statement. Cash flow is cash from operations less capital expenditures. We talked about how much they're investing into their business. Well, let me show you. Look at these capital expenditures, guys. 2019, 16.8. You ready? 40, 61, 64, 53, 83, $120 billion last year. You know, I give Amazon a lot of credit. They're thinking about 3 to 5 years ahead at all times. Jeff Bezos says, I don't even handle day-to-day operations. My goal is 3 to 5 years from now. And I love that about him. He has a great saying where he says, everybody's trying to figure out what's going to change in the world in the next 10 years. I'm trying to figure out what's going to stay the same. People always want cheaper and people always want faster. I love that. So let's look at these analyst estimates. Profit doubling in the next 4 years from $7 a share to $14 a share, and revenue growing at around double digits, 10% a year, going to 1.1 trillion in the next 4 years. Sorry, that's incredible. So let's pull up Amazon because this one's going to be harder because of the growing profit margin. So here are my 10-year assumptions on Amazon. I did 4, 7, and 10% revenue growth. They have 10% in there for the next 4 years. I'm going to go a little bit lower on revenue growth, but I can understand if somebody said, actually, you know what? I'm going to make this 4, 8, and 12. Profit margin. Now, guys, look at this. I did 8, 12, and 16. Keep in mind, my middle assumptions are higher than any of the numbers they've shown. But I'm going to assume that that profit margin is going to get higher and higher as their ad business and the AWS keeps getting bigger and bigger. So I'm giving it the benefit of that growth. PE, great company. ROIC is getting better. Can we all agree that Amazon is a moat? Literally, whenever somebody sells online, you go, why don't you just sell on Amazon? That's how much of a moat they are. I put in 20, 23, and 26, and I did my 9% desired return. I hit the analyze button. I have made every possible investing mistake you can imagine. I bought too high. I sold too early. I listened to the wrong people. And that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. And guys, this is interesting. I have a low price of 100, high price of 450, middle price of 226. So it's getting close there. Now, the stock is currently on a watch list of $100 a share. Obviously, I had not done it in a while, but remember, I also gave very aggressive assumptions here. So what I'm going to do is I'm actually going to add it to my watch list at 180. Now, I'm not saying I'm buying it at 180, but what I do is if it falls further, I want to be able to analyze it again and say, okay, what's happened to those profit margin levels? Are they still getting better? Now, the third stock we're going to analyze here, Starbucks. Guys, another company I own. I don't have to give you the spiel again. Do not buy a company because anybody on the internet or even Warren Buffett owns it. But Starbucks is your legal drug company with a strong brand, loyal customers, and steady cash flow. Starbucks isn't a fast grower in the US anymore, but it continues to expand, especially in China, and has raised its dividend for over 14 years in a row. The company is investing in its operations and its digital rewards program to keep customers coming back. But like all companies, they do face challenges, such as rising costs and strong competition. Analysts expect Starbucks to be more of a steady long-term play than an exciting growth story. Now, we just need to run the numbers in our stock analyzer tool to determine its value. Because remember, guys, just because the growth story isn't there, that doesn't mean the stock is awful. It means that you have to factor that in when analyzing the company. Starbucks, $97 billion market cap, enterprise value of $134. Big difference there, but remember, they have tons of leases, so I'm not worried about that. 5-year average free cash flow and the 5-year net income is about the same, $3.3 billion. Last year's free cash flow of $2.45 beat out its net income. Okay, so nothing awesome, but look at this. Their price of free cash flow is 40. A little expensive. Pays a healthy dividend of 2.85%. And in our community, the average rating is a hold with an intrinsic value of $64, and it's currently at $86 per share. But here's what's awesome. Look at these returns on capital. 50% in the last 5 years, 35% last year. Guys, they cannot invest money at 50% returns, but it just goes to show what a great business Starbucks is. It's an incredible business, and you have to remember it deserves a premium for that exact reason. 8 pillars. All right, debt, I'm not worried about, but these are the two metrics. 5-year PE and 5-year price of free cash flow could be expensive, but let's go look at analyst estimates, because look at this, guys. $222 per share in earnings growing to $686. That's 3x in the next 5 years. That's a lot of growth, guys. At $686, let's say you apply only a 20 multiple to Starbucks, that's $136 stock just from that. The question is that worth the squeeze if they're right? With revenue growth going from $37 billion to $61 billion, that's going to be a combination of prices going up as well as opening new locations and growing markets. So let's go back to our stock analyzer tool. Let's pull up the Stizzle Bizzle, Starbucks. Let's looky here. So guys, 10-year analysis, I did 3%, 5%, and 7% revenue growth, which I think is with growing costs, with growing prices, as well as new stores, doesn't seem unreasonable. Profit margin, I did 10, 11, and 12%. Same with free cash flow. Obviously, profit margin and free cash flow are down a lot recently in the last year. Has to do with probably a lot of restructuring and turning things around. Now, PE. Guys, high quality business. If I asked everybody out there right now, what's the number one coffee company? How many are going to say Starbucks? If we're on the Family Feud and say, we surveyed 100 people, we asked them for the best coffee company, how many would say Starbucks? That's a pretty obvious answer to me. I bet 20, 22.5, and 25. And again, my 9% return. Hit the analyze button. The stock's 86. Okay. Low price of 60, high price of 113, middle price of 82. That includes their dividend for the 8.5% return. So I don't blame people for our community members saying this is a hold. But they put the average value of $64. I'm higher than them. My intrinsic value is somewhere in the mid 80s. All right. Now, earlier this year, I picked 7 stocks to go head-to-head against the stock market's Magnificent 7. I want you to click the video on your screen to see which 7 stocks I picked that I own and how they stack up, because the results will probably surprise you. Thank you for your time.